In this video, we will talk about how billionaires avoid paying taxes, legally and illegally, so make sure to watch the full video. Billionaires often pay significantly less in taxes than ordinary citizens, despite earning vast amounts of money. This reality is partly due to legal tax strategies that the wealthy use to minimize their tax bills and, in some cases, illegal tactics to evade taxes altogether. Understanding how billionaires reduce their tax burden reveals the complexity of the tax system and the advantages that come with wealth and access to expert advisors. From loopholes and offshore accounts to philanthropy and complex trusts, billionaires use a range of methods to protect their fortunes. This article explores both the legal ways billionaires lower their taxes and the illegal schemes some have used, highlighting the blurred line between savvy financial planning and unethical behavior. 1. Using offshore tax havens to shelter wealth. One of the most common methods billionaires use to reduce their tax liabilities is by placing assets in offshore tax havens. These countries or territories offer very low or zero taxes and strong secrecy laws, allowing billionaires to hide income or wealth from their home tax authorities. Offshore accounts and companies make it difficult for governments to track money flows, legally reducing tax exposure. While this strategy is legal when fully disclosed, failure to report offshore holdings can cross into illegal tax evasion. The Panama Papers scandal exposed how many billionaires exploited these havens, showing the scale and complexity of this practice. 2. Exploiting loopholes in tax laws. Tax codes are complicated, and billionaires often hire top lawyers and accountants to find loopholes that reduce their tax bills. These loopholes can include deductions, credits, and exemptions designed for specific industries or activities but that billionaires exploit broadly. For example, using carried interest loopholes allows investment managers to pay lower capital gains taxes instead of higher ordinary income taxes. These legal strategies, while controversial, are technically allowed under current tax laws. Governments sometimes close these loopholes, but new ones often emerge, keeping billionaires one step ahead. 3. Paying themselves in capital gains instead of salaries. Many billionaires reduce their tax burden by structuring their income as capital gains rather than regular wages. Capital gains tax rates are often significantly lower than income tax rates, sometimes less than half. For example, Elon Musk and Jeff Bezos reportedly pay very little in income taxes because they take little salary and mostly earn wealth through stock appreciation. This legal tax strategy allows them to defer paying taxes until they sell assets, and even then, at a lower rate. Critics argue this system favors the wealthy disproportionately. 4. Setting up trusts to protect wealth. Trusts are legal entities that billionaires use to protect assets and reduce taxes across generations. By transferring wealth into trusts, they can avoid estate taxes or delay taxes for heirs. Trusts can be designed to control how assets are managed and distributed, and they offer privacy benefits. Wealthy families often use complex, irrevocable trusts that shield money from taxation while maintaining family control. While these arrangements are legal, they require expert advice and significant upfront costs, making them accessible only to the ultra-rich. 5. Charitable donations and foundations for tax deductions. Philanthropy is not just about giving back. Billionaires also use charitable donations and private foundations to reduce taxes. By donating stock, cash, or other assets to charity, billionaires receive large tax deductions that can offset income or capital gains taxes. Foundations allow them to control how donated money is spent while gaining tax benefits. However, some criticize this practice as a way for billionaires to maintain influence and avoid taxes without necessarily benefiting society as much as they claim. 6. Using debt to offset taxable income. Billionaires often borrow against their assets, such as shares or property, rather than selling them, to fund their lifestyles. Since loans are not taxable income, this strategy allows them to access cash without triggering capital gains taxes. This buy, borrow, die strategy helps them maintain wealth while minimizing taxes over their lifetime. Legally, this approach is sound, but critics argue it highlights how the tax system favors the wealthy, who can leverage assets rather than sell them. 7. Tax inversions and moving headquarters. Some billionaires reduce taxes by relocating their companies to countries with lower tax rates, a practice known as tax inversion. By shifting headquarters abroad, companies and their owners can benefit from lower corporate taxes. This legal tactic is controversial and often criticized as unpatriotic. Governments have enacted rules to limit inversions, but businesses find ways to navigate the system. Tax inversions highlight the global nature of tax competition and how billionaires can use it to their advantage. 8. Taking advantage of real estate tax benefits. Real estate investments offer billionaires various tax benefits, including depreciation deductions and 1031 exchanges, which allow them to defer capital gains taxes when swapping properties. These tools legally reduce taxable income and preserve wealth over time. Many billionaires build vast real estate portfolios, benefiting from these tax advantages. While these incentives promote investment, they disproportionately help wealthy investors and increase wealth inequality. 9. Using family limited partnerships. FLPs. Family limited partnerships are legal structures that allow billionaires to transfer assets to family members at reduced tax costs. FLPs offer valuation discounts and help avoid estate taxes by dividing assets among heirs over time. They also provide control over the assets while giving heirs ownership stakes. FLPs require legal expertise to set up and manage but offer a powerful way to pass wealth tax efficiently. While legal, some view FLPs as exploiting loopholes to reduce tax obligations unfairly. 10. Illegal tax evasion. When strategies cross the line. While many strategies to reduce taxes are legal, some billionaires have been caught using illegal tax evasion methods, including hiding income, falsifying documents, or offshore tax fraud. Illegal evasion carries serious consequences, including fines and imprisonment. Notable cases like that of Leona Helmsley or Bernie Madoff show that the pursuit of avoiding taxes through unlawful means risks reputational damage and legal penalties. The line between legal tax avoidance and illegal evasion can be thin, but intentional fraud is criminal. Billionaires use a complex mix of legal tax avoidance strategies and, in some cases, illegal tax evasion schemes to minimize their tax burden. Legal methods such as offshore accounts, trusts, charitable foundations, and debt financing allow them to protect and grow wealth while paying less tax than most people. However, some cross the line into illegal practices, risking harsh penalties. These tactics highlight flaws in the global tax system and raise questions about fairness and transparency. While billionaires benefit from expert advice and sophisticated planning, ordinary taxpayers often bear a heavier tax load. Governments worldwide continue to reform tax laws to close loopholes and enforce compliance, but the wealthy's resources often allow them to stay ahead. Understanding these methods provides insight into the challenges of tax reform and the ongoing debate about wealth inequality and tax justice. What do you think of our video? Let me know in the comments section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. Thank you for watching.